Eddie, you're muted.
Yeah. Let me start my whole spiel again. My goodness. Yeah. Man, I made a world-class speech and then none of that went on record. So let me start over. So hello, welcome to Saturdays with Eddie. Today's Saturday, March the 4th. This is Saturdays with Eddie, an educational session. It's not financial advice. We get together every couple of weeks just to talk about options and the strategies that help us move forward. The objective is to gain consistency and a good understanding of the fundamentals. We know that we trade small. We are not looking for huge dollars. We're not looking for that $3,000, $4,000 a day kind of deal. We're looking for small gains consistently. That's where we're trying to get to. At least that's what we have found to give us success. So welcome everyone. If you want, if this is your first time, say hello. Tell us where you're from and what you're looking for. See, Mr. Walt over there is smiling. He's about to break out. He's about to say hello. You guys able to mute? I think you can mute and mute. All right, that's cool. You guys can type too. So we have a few things on the agenda. We are going to talk about maybe some memorable trades. That's what Dora wants to talk about. We'll take a look at that. We'll look at the market outlook. Today, what I had in mind was more on a beginner level. Just a refresher on moneyness. Moneyness is where we talk about at the money, in the money, out of the money, and implied volatility, how that actually affects our trading, what we should be looking for in options prices, essentially to guide us. You know, what does that tell us when you're looking at the options price and the volatility? What should we be looking out for? So anybody else want to talk about anything, major questions you want to bring in? No? Well, if you think of any questions or any topics you want to add, today we have just about an hour or so, give or take, and we'll take a look at that. So cool. So let me look at let me share my screen here. Hopefully you should be able to. Did I share the right screen? No, I don't think I did. Let me try this one more time. I'm going to share desktop 3, which is that one. Yep, that's the right screen. That's the right screen. Okay. Are you all seeing a chart of SPY? Is that what you're looking at?
Yes.
Chart of SPY. Okay, great. So I like to look at the S&P 500, which is what I trade the most. But what I always tell you guys not to trade the most. So why am I looking at it? And yet I tell you guys not to trade it. It's because most of you are trading that anyway, right? That's what most of you are trading. But there's a reason to look at the S&P 500. It's because it's representing the 500 strongest companies, some of the 500 strongest companies in the US. And it's an indicator of how the American economy is doing for the most part. So these and the Dow Jones and the NASDAQ and all that, all those combined, they give us a good picture. But S&P is one of the most widely traded. I think it's the most traded index in the world, hands down. I think they did a study, which was really, I don't know whether it was necessary at all, but just to see which indexes are traded the most. And SPX is traded not just here in the US, but surprisingly, a lot more outside of the US than in the US. That's because it's so stable. You know, it's so popular and it has huge liquidity. 2 to 3 billion contracts are traded Monday through Friday, every day, every single day. So right now, what I'm seeing is expected movement. Right, we're seeing exactly what we thought was going to happen, at least I thought was going to happen based on how the chart looks like. So we know that we like to make V's, and we like to make upside down V's. So every time the stock goes up, goes down, makes a V formation, for the most part, that is what happens on a general scale. And it does make complete V's, so on complete 10. So you can see that every time we have a V, we have got a base, or we can turn this triangle upside down. That's always going to happen. So right now we are in this trend over here where we think 4175, 4180 is in the books, or even 4200 might be in the books here in the next few weeks. So I'm expecting an uptrend, right? We hit support here, we bounced off support, had a hard time going up, but we did hit support. I thought we were going to go down to this 3900, 3900 level, but looks like the market said no, we're done going down. So if anything, we might come back and feel this little space down here, but the general trend as the moment is upward. Right? How long do we think it's going to go? I'm not too sure, but I think 4150 here is not too far off from getting in the books in the next few weeks. If that fails, then inflation is going to hit us. We're going to come back down. We might be able to test those 3,700 levels again. Not surprising, but it is highly possible. So anytime that we get into a plan, remember there's always going to be two theses, right? Two theses. Every time you're trying to trade, especially calls and puts, we know that it could go up or it could go down, right? As that could be a joke, but it's more or less the truth, right? You have to think in terms of what are the two main possibilities that will trend. We're either going up or going down. So you have your thesis for both. When I say you have your thesis for both, it means that you should plan. And that's where you need to know how to plan for each of those theses. So I might be picking on some of you just to kind of pick your minds and see what goes on in your mind when you're planning for such movements. So as far as a memorable trade, this week I didn't do much. In terms of trading, I was kind of under the weather, but did not do a lot of trading. I think I probably made like 3 trades is what I was telling Dora. And frequently I do go to the 15-minute chart. Right now I don't see anything. Did not trade last few days. So I'm going to have to pass on that one, Dora. What do you think? We might come back. We might see another trend somewhere, but for the moment, I don't remember anything that I can share at the moment. So
That's good.
But as we look at a few more stocks, we'll try and get some ideas.
Okay.
Yeah. Let's see. Moneyness. I like to pick on Apple, by the way, guys. Apple is it's a good thing here. So, by the way, have you seen the new login screen for Thinkorswim, guys? Has anybody looked at it? When I logged in this morning, they had the new login screen that they've been talking about. So I don't know what.
I just saw it this morning.
Yeah, I think they changed things on Saturdays when they're doing their maintenance. So today is the first day. All right. Let's see who's new to options. Let's start there. Who's new to options? Has not traded options. Has done less than 10. Let's go with that. Less than 10 trades using options. Who's new to that? Well, okay. You've done less than 10. You've done 2. Okay. All right. You've done less than 10. Okay.
Yes, less than 10.
Less than 10. What do you look for? Let me put you on the spot there for a brief second there, if you don't mind. Uh,
Well, I'm still in the beginning stages of trying to grasp everything I know about, the well, God, my brain just froze up. But about how to pick your expiration dates and the ags and the bid, the
Yeah.
spread, whatnot. So I'm just getting all the concept together.
Yeah.
And whatnot. So
Okay.
I've been watching a lot of your old videos, just
Yeah.
going through different ones and getting different concepts together. I've
Absolutely.
been referring a few people to your class as well, which 2 of them has already joined.
Nice. Thank you. Appreciate that.
Yes. I'm just waiting to build my funds up so I can join myself.
Awesome.
I'm coming to Eddie's University.
All right. And he's talking about options with Eddie. That is you can, if you haven't heard about it, it's optionswitheddie.com. So that is where we all get together and try and make head or tail of this. So just to put together what Walter is talking about there is there are certain concepts that we look for, right? So I'm going to look at, say, Apple here. The first thing, obviously, that we do is we need to know how to read the chart. So these are basics that I'm talking about. We need to know how to read the chart, know where we are, and then decide where we're going. That is at least that's the game plan for most people, I hope. So if you're a beginner, this is where you start. You have to understand what is it that you're trading. If you've been trading shares, it's fairly straightforward with shares. You know that if you want to make $10 using Apple, what do? You just go buy 10 shares of maybe Apple, and right now the cost is $151. So you're going to spend what? About 151 times 10. Boy, my math is bad. About $1,500. Wait for Apple to go up $10 and you make $10. How about that? Is that a good use of your money? You could argue. If you don't know any other way, yes, it is a good use of your money because you bought something that is stable, something that you can hold on for a long time. You can hold it for 10 years. Fine. We know that Apple has been around for a long time. It's going to be around for a long time. Hopefully you can gift those shares. It is tangible. It's a store of value. Basically that value, even if it might go down a little bit to 142, 140, and so on and so forth, eventually it does come back up. Now, when you talk about options, that is not the case. It has got an expiration date, right? It's kind of like insurance. Let's talk about insurance. When you talk about insurance, you're insuring something that has value and there's a time period to it, right? You're insuring your Nissan for 6 months and you're paying $1,000. And, 3 months down the line, if you want your money back, you're not going to get that $1,000. Time will have flown by, it will have passed by. And so it's no longer worth the 1,000 unless your Nissan has increased tremendously in value, in which case, still, you might still not even get 1,000, but there's time value. So we'll look at how all of that impacts what we trade. So when it comes to options and you buy one contract of Apple, one contract represents 100 shares, right? That's with options. When it comes to other instruments like futures, one contract might not necessarily be 100 shares. Could be 50, could be 25, could be 10,000, right? And it could be in any kind of units. For instance, if you're trading, oil futures, CL, then, you're talking barrels of oil. If you're talking grain, you're talking soybeans, coffee, tea, whatever. But when it comes to options, contracts, one contract always represents 100 shares. So think in terms of that. And so when we buy one contract, usually we're making a wager or a bet and saying that my thesis is that the price of the underlying, here being Apple, is going to increase from 151, which is the current price now, and it is going to grow to maybe 150, say we'll call it 156, right? So I'm hypothesizing here that I expect the share price of Apple to go from 151 to 156. That's a hypothesis, right? So how do I take advantage of that? How do I take advantage of that? The way I do that is by buying one contract and saying that I will guarantee myself to buy Apple at a lower price than 151. And when it goes up to 156, my contract will be worth more. Right? Let me break it down. Let me break it down for you guys. So I'm going to pick an arbitrary date here, 24 March, and this is not the right date to pick, but I'm going to pick it anyway. So I am saying that if I buy the 150 contract, the 150 contract, meaning the 150 strike. So you're familiar with the options chain. Hopefully, if you're not familiar, you need to watch one of my videos on the Greeks. On the Greeks. But I'm going to pick a strike that is less than the current price. So this is the current price, 151.03, and I'm going to pick the 150 strike. Why do I pick the 150 and not anything else? It's because it's already at the money, right? It's at the money, or it's in the money, slightly in the money. So the definition of moneyness here, let's talk about at the money. At the money is the strike, any of these numbers here, right? That when we're referring to calls, if the strike is actually both calls and puts, when the strike is equivalent or equal to the current price, or very, very close to, then we can say that that is at the money, right? That's at the money. We can go a little bit further and evaluate, is that strike price below or above the current price? Below or above the current price, and is this a call or a put? So let's start with the calls. The calls, we know that are bullish, meaning that we expect the price of the underlying to increase, and so we do what? We buy a call. So if the strike is less than the current price, meaning if this 150 here is less than the current price of 151, then we know that that strike is in the money or at the money. The key thing here is that the strike has to be less than the current price. So every strike that is less than the current price is in the money, right? Everything that is less than the current price is in the money. So you can see that Thinkorswim actually does help you, and it puts a light shading here. I think if you're looking at my screen and hopefully the colors are coming through, then that is going to be shaded purple, right? So this is very basic, by the way. This is a refresher. Hang on a second, I'm going to sneeze. There we go. Yeah, I'm still on the tail end of recovery here, so everyone's
God bless you.
Yeah, thank you. Do you want to sneeze in your face? So we're talking about here the moneyness, the in the money. So we can see that Thinkorswim is actually helping us here and shading it for us. So we know that everything that is in that purple background shaded color, that is in the money. We know it's in the money because the strike is less than the current price. Similarly, or on the opposite side, when we are referring to puts, meaning that we've now changed our thesis to where we think that the price of the underlying is going to go down, everything that is above the current price. What is the current price? 151. So anything that is above 151 is automatically in the money. I just shaded it there, or I just drew a yellow rectangle around that. So if the price is less than the strike, or I should say it, if the strike is greater than the current price, then that's in the money. And we'll see how that plays into effect. We'll throw some examples on that. Let me also label that so that you can ask questions in case. See, this is ITM. This is ITM here. This is out of the money. And I want to invite questions. Anybody who's not familiar with this concept? Anybody who's confused about that before we go on? Okay, you all are good, huh? All right. So what strikes do we choose when you're trying to buy a contract? Which strike do you choose? So the way that I prefer and the way that I think that it should happen is that you should buy, if you're expecting the calls, if you're expecting the price to go up and so you want to buy a call, then you should select the strike that is at the money or slightly in the money, right? Which means that I would pick where's my pencil here? Which means that I would pick the 150 strike if I thought that the price of the underlying is going to increase. If I thought it was going to go up, then I would choose that 150 strike. It is qualifying on two things. I'm going to introduce another concept here. Number one is the strike is less than the current price. Number two, I'm going to look at this value here called delta. Notice that delta here is 0.57. Delta goes from 0 to 1 or 0 to 100. It's expressed as a decimal. So when we say delta 57, we're actually saying 0.57. Say delta 70, we mean 0.70 and so on and so forth. So if it has a delta of 50 and above, then it is in the money or it is at the money. So when you're picking your strike, you want to pick the one that is at the money or slightly in the money. Two qualifications you need to take into consideration are just the price, or rather the relationship between the strike and the price. This is going to be lower, and the delta has to be at least 50. Anything above 50 is good. You with me so far on that? So why would you pick that and not anything else? What difference would it make? You're going to make money anyway. What difference would it make if you picked, for instance, the 144 strike? Why wouldn't we pick the 144 strike? First, you notice that if we picked the 144 strike, we'd be paying how much? $895. Right? $895 versus if we pick the 150 strike, we'd be paying $470. So you might think, well, that's almost $400 difference. Maybe I should even go lower and pick the 165 strike and pay only $22, right? So we have to ask ourselves, how is it that we make money when we buy a contract? How do you actually make the money? So think about delta as the rate of change of premium. When we theorize that the underlying is going to increase in value, the value that we are referring to is this premium that you paid, the $470 that you paid. So if you pay $470 and Apple goes from 151 to 152, how much is the contract that you paid for $4.70 worth now? Right? How much is it worth now? And to find that value, we simply take the value of delta and add it to $470 for every $1. So here's a pop quiz. If Apple value increases by $5 and you bought a contract, the 150 strike, for $4.70, assuming that the price of Apple is now 156, how much would that contract be worth now?
0.57 by 5.
So it would be worth how much? So
0.57 by 5, but you add that to the 470.
Okay, so do the math for us. How much is that total?
That's 2.85 plus 4.70, so that's 7.55.
Nice. I'm liking this. So it means that if I bought this contract, this 150 strike, I would make how much exactly? Is that the 285?
Yeah,
the 285. So we can also see here that the amount of the movement of the underlying times the delta is also how much profit we're expecting to make. So 2.85 is what Patrice told us because she multiplied 57 times 5. right? That's how she got $285. Remember, 4.7 in premium is actually $470. So don't think that you only need $5 in your account. No, you need $500, give or take. So let's do another example here. Let's say that Patricia's neighbor bought the 144 strike, right? So Walter, you bought the 144 strike. Based on that example we just saw, how much money would you make if Apple just moved up $5? What's the math behind that? Anybody can pick that up, that answer. So I know Patrice knows it. I just want to make sure somebody else knows how to do that math.
Would it be $1,088?
Well, tell us how you got to 1,088.
So you said if it moved $5, right?
Yes.
So I added $5 to the $8.95, and then I multiplied it times the 0.78. And then I multiplied that times 100 shares.
Let's see. I think that math is a little bit off.
Did I do it?
Yeah. So the delta, let's walk through this again over here, Leslie. The delta is what is telling us that every time that the price of the underlying moves up by $1, then this premium here increases by the amount of delta, right? So when it moves from 151 to 152, the value of this contract that we bought at $8.95 is now how much? Could we say
If it goes up to say that again?
To 152, it just increases by $1.
Oh, it just went by $1.
Yes. Is it 8.95 plus 0.78?
Yes.
No.
Yeah.
Yeah.
Because the delta here is 78. That's what we're looking at. You know what? Let me clear my screen and give you a better picture. This is the one that we're working with right now. We're working with the 144 strike. The ask is 8.95. The delta is 78. We're trying to figure out that if the price of the underlying, if Apple went up by $1, how much would this contract, this 144 contract, how much would that be worth now? So we know that, excuse me, we know that it cost us $8.95, and that if Apple increases by $1, we're going to add 78 cents to that $8.95. You with me on that?
Correct.
So if it goes up yet another $1, then we just add another 78 cents. We're doing these on a straight line basis. Obviously, there's little fluctuations, but on a straight line basis, if it moved up $2, then we would be doing 0.78 times 2. Is that right?
Mm-hmm.
But this time we've been
okay.
told,
I see what I did wrong.
right? So we've been advised here that Apple is actually moved $5, a total of $5. So we could do 0.78 plus 0.78 plus, or we could just do 0.78 times 5. Is that right?
Mm-hmm.
And that gives us how much?
3.9.
3.9 in premium, which is actually how much in real dollars? Times 100.
It's 3,900.
More like $390.
Wait. Oh, I said 1,000. Yeah, times 100. Sorry.
Yeah. Leslie, I'm going to buy you a calculator.
I'm telling you.
I'm going to buy you a calculator.
I'm using my calculator, but it's 100 shares, and I did it times 1,000.
What does this look like? You see these? walk down the street. As soon as this call is over, walk down the street. You know what you're going to do today, right?
Get some sleep.
Well,
that's the real issue. But yeah, I do. I know what you're saying.
That too. Yeah. So get after you sleep, after you take your nap, go ahead and buy a calculator. Yeah. And because 3,900. I'm gonna quit.
So can I talk through it?
Yes,
I talk through
please.
it? So if you bought a strike at 144 and it moved up 5 shares,
yes,
or 5 points, then you would multiply the 5 times 0.78 to
Mhm.
know
Mhm.
how much you would make on it. And if
Yes.
you multiplied the 0.578 times 5, it would go to 3.9. There's 100 shares in each contract. So then you multiply that by 100,
Mhm.
which would get you 390.
Correct. That's how much you would make if you
Mhm.
sold that contract at that particular moment. Yes.
Mm-hmm.
So the question is, how much would you sell it for? If you bought it at 895, you're expecting to make 390. How much would you sell it for?
At at 390 it would go up 154.
Let me give you another example here, Leslie, right? Let's
It's
say,
going up to 3.9.
yeah. So Leslie, we want to buy some pineapples, okay? We want to buy some pineapples,
Okay.
right? We're going to buy some pineapples for $10. Okay, $10. These are very expensive pineapples, $10. And we want to make $5 on each pineapple. So each pineapple costs $10, and we want to make $5 on each pineapple. And right now we're starting small. So you go to the market with your one pineapple and you want to make $5 that you bought for $10. How much would you sell it for in order to make that $5?
Sell it for 15.
You'd make it for 50. You'd sell it for $15, right? We have to agree on this, Leslie. What do you think?
Yeah, I said sell it for.
Sell it for
Can you hear
15. Okay. Yeah, you might have broken up there a little bit. So we sell it for 15. And the math on that one was real simple. It was simply how much we bought it for plus the profit that we're taking, which is the $5. So 10 plus 5 is 15. So if you sell it for $15, guess what? You've just made $5, right?
Right.
So let's come back to this example. You bought this contract for
Got it.
$895 and you're
And you're
expecting to make
selling it.
$390. So how much would we sell it for? Would it be $1285 plus $390? Shake your head. Say yes.
Yes.
Yeah. Yep. So and that on what's the math on that? And I know you don't have a calculator there, so I'll do the math for you. So that answer would be 12.85. Yeah, 1285. So let's do this in real life. How about that? Let's do something. I'm going to set up an order here. I'm going to buy. I'm just going to click on it, and I'm going to buy these for $8.95. And I'm going to do my take profit. So here's what I'm going to do. I'm going to do fast triggers OCO. So I'm going to do an opposite order because I have to sell it in order to make profit. So we have just identified that we are going to make $3.90. So my selling price has to be at least $12.85. You with me on this?
Yes.
This is how you set up your order, right? But you have to know how much you're going to buy it for, which is the easy thing because it's spelled out on the screen. And you just calculated how much to sell it for. Otherwise, we wouldn't know how much to sell it for if we didn't know what the movement was. We are together on this now, right?
Yes.
Good. My point here that I was trying to make before we went into all of that is that originally we had picked a strike of 150. We picked a strike of 150 and we spent $470, but we only made $285. Whereas when you pick the 144 strike, for the same $5 movement, you made $390. So the difference there was $390 minus $285. That's you made $105 more than the person who picked at the money. Do you see how that is starting to tell us which strike we should pick?
Mm-hmm.
Right. So if I pick the 150 strike, then and you pick the 144 strike, you're more than likely, actually not more than likely, you're definitely going to make more money than I will. How much more? 105. But you're going to spend $400 more. So we need a nice balance of, I don't want to risk too much, right? Because in the same token, if we were to lose $500, sorry, if we were to lose 5 points on Apple, you would lose 390, I would lose 285. So you see where we're picking up the middle ground? Let's do one more example here. We're going to talk about the 165 strike, right? This is the person who thinks that, you know what, I don't have a lot of money, so I'm going to pick the 165 strike. So let's do another example here. Let's pick on somebody else. Actually, Marlon, I think you know how to do this. So Marlon, let's say you pick the 165 strike. How much would you pay for this?
Say $22.
About $22, right? Really good deal, wouldn't you say? $22, not a bad deal. Now, Apple moves up the same $5, goes from 151 to 156. We're trying to see how much would you be able to sell these for? What would that answer be? And how do you get to it? Break it down for me, please. Would that be the delta times the movement?
The delta time the movement.
Yeah.
Can give you roughly about 30 cents.
About 30 cents, because he did 0.06 times 5. He got 0.3, means that, excuse me, 0.3 in premium is how much he got. And if we multiply that by 100, that's about $30. So he'd make about $30. So you can see that when you are at the money, you're kind of average, you're in the middle of the ground. When you're deep in the money, remember, the farther you go in the money, it's called going deep in the money. You make a little bit more, well, a whole lot more, actually, $390. And if you buy out of the money, you only make $30, right? You only make $30. So would it make sense anytime to go out of the money for $30? I don't think it makes a lot of sense, because guess what? If it took 10 days for this price to go from 151 to 156, more than likely this $22 would be gone, meaning that it would decay to almost zero, because it's so far out of the money, it only has a delta of 6, right? Delta 6 here means that it has a 0.6% chance or 6% chance of expiring in the money, right? And when you're that far out, it means you have zero, exactly zero in the money. So I don't recommend buying anything out of the money unless you're following a particular strategy that calls for buying out of the money. And there are strategies like those, but not for straight calls and straight puts. So don't buy out of the money. As a matter of fact, I highly recommend you go delta 50 to delta 70, somewhere inside that range. That's your best, that's the best range that you want to pick up. So we've seen that out of the money. Let me get my text tool here. So we've seen that this is out of the money, OTM equal to bad, right? In the or ATM here equals to good. And deep in the money, you can call that gravy, right? That's how you spell gravy, by the way, guys. And you guys, some humor, guys. Come on, guys. Just put you on the floor.
I have a question.
Yes.
If you buy in the gravy, would you usually have a limit price to get out or a limit points to get out?
You can.
Which one is safer? Is there one that's safer?
I think that at the money or slightly in the money is where I find my comfort level at, right? The reason I would say that at the money is much better is because you're balancing risk as well as reward. you know that the deeper that you go in the money, the more money that you can get faster, right? That is fact. But we also know that if Apple were to reduce in price, even by $2, it means that I'm now losing what, 78, about $160 almost, right? As
Okay.
opposed to about $100 at the money. So you have to balance that risk of, yes, I know I can make more money, but I can also lose more money. Where is the balance where I'm not losing so much and I'm not getting so much? I'm earning just right. And that number would be at the money. So that's why we always go with something that is about, 50, between 50 and 70 delta to help us. Now, you asked about a limit price. Would I put in a limit? Are you referring to a take profit, or are you referring to
The take profit exit.
the take profit? So my take profit would be relative to what the delta is. So knowing that I have a capability of getting $390 on this deep in the money, then I probably might do a +4, right? You understand that a +4 here is plus $400, right? 390 and $4 are pretty close to each other. So I might be able to modify my my order here and do instead of doing manual, do a trigger here and do a +4. How about that? So do plus 4.00, and I would get out much faster. Price doesn't even have to move. Price doesn't even have to move $5, right? And you're asking, how is that possible? How is it that price does not have to move $4? We know that delta is not constant. Is that right? So
Right.
delta is not constant, and delta is influenced by other metrics like Vega and what is it? And gamma. So let me clear my screen here, and I'm going to also add a few more things. I'm going to add all these things. So we're still talking about the 144 strike, and you notice that my delta is what? 0.78. See that? And the gamma is 0.3 and my Vega is 11. If I had a volatility spike, it means that this gamma or this delta, or both actually, would increase exponentially. They increase more the deeper in the money that you get, which means that you're able to get even better than $4 much more quickly than if you were at the money, and definitely much more quickly than if you are out of the money. So out of the money have got so many disadvantages that you simply just should not even consider them. So the reason that I wouldn't go for very deep in the money is because of risk. I want to manage the risk, because the faster that I can get up, it means the faster I can get down as well. Make sense?
Yes.
Yep. Cool.
So Eddie, even with the Vega influencing delta and where it is in the chart where current price is, it wouldn't matter if it didn't move up the $3 or $4, it would still, is that what you're saying? That it would still get to however much you want it with that, if you put the trigger point at $4?
So the trigger +4 is, I'm simply telling the system that when I buy these contract at $8.95, I'm saying that when you get $4 of movement in premium, go ahead and sell it.
And premium, right? Not in underlying stock price.
Not in underlying stock price. If
Got
I wanted to make this order based on the price of the underlying, I would have to do something different, right? I would have to do something different to do that. So that's a complicated way to do it, to add that. In other words, what you're saying is that I want to buy the contract at 151, at the 144 strike, okay? And I want to sell these when the price reaches 156. Right? That's your question. I think that's is that what you're trying to get to? Okay.
Yeah.
So you can do that. You can do that, and I can show you how to do that real quick. but that's a complicated way.
But yeah, but that's not, I guess I didn't realize that you could do it in the way you just showed us. Cause you said basically you can get out faster than what the underlying price moved. Is that
Yes.
what you just said?
That's what I just said. Yes.
Okay.
And in that
I'd
scenario,
rather do it that way
Yeah,
than go by the underlying price.
oh, you never want to go by the underlying price. No, because
Okay.
you're trading in the contract, not in the underlying. We forgot about the underlying, right? Once we enter the trade, we're not even looking at it so much. All we theorized was that the price was going to move from 151 to approximately 156. That's what we said,
Mm-hmm.
right? That's the basis upon which we decided we are going to buy a call. Now, this is not an A+ trade. It does not meet the qualities of an A+ trade, but it is giving us a good example of what would you do, or what would one do if they were to take advantage of price increasing of the underlying.
Got it.
Okay.
Okay.
So the next step over here would be to qualify each of those trades and make sure that one, is it meeting my goal? You have to have some goals. If you don't have any goals, you're going to hit them every single time, or you're going to hit something. More than likely the floor. Yeah. But you want to plan in a way that you are getting a good trade. We emphasize quality over quantity, right? Quality over quantity. So, but I like that question there. So does everybody now understand why? And I'm going to remove all of these other things because they don't help me make any decisions. I'm simply going to customize these and I'm going to remove all of that. How about that? Can I do them all in one setting? Yes, I can do that. Okay.
So if you're making the decision based off of Delta and Vega, why would you remove Vega? Or you're just making the example that Vega does help Delta to move quickly. Okay.
Yeah, that's the point I'm trying to make. But I make the decision of which strike to make using the value of the price of the underlying, the strike value, and the delta. Those are the three things that help me pick what strike I am going to choose.
Okay.
Okay. Everything else is just relative. I know that they are all affecting because delta is the rate of change of premium, Vega is the rate of change of delta, Vega, and then or is it no, gamma is the rate of change of delta, Vega is the rate of change of both delta and Vega, and then we go on to rho and we go on to all those other Greeks. That's a lot of math, right? You don't need all of that at the nitty-gritty level. You don't need that. Just go with the simplest metrics that you need to pay attention to, clear out everything because you can have 1,000 columns here. Just leave the ones that you need. Delta, bid, ask, strike. 4 things, right? So you have a formula now. Now let's look at the one other side here, just for instance, so that we can whet some appetites here of what if the price was going down, right? So the price being 151 and say we're going down to the support level of 143, that's a difference of what? 151 and 143 is it's about 8 points, right? We haven't adjusted for anything yet. We could see that if we were to buy a put, right? A put would be a concept that allows us to take advantage of when prices of the underlying are reducing. So we'd go over to the other side, says puts, and let me go ahead and draw some lines around it. So we'd be playing on this side now. We'd be looking for the first strike that is in the money, meaning that it is greater than 151, right? It's greater than 151 and it has a delta of at least 50. So would the 152.50 be a good one? The answer is yes. Do I like the ones with a decimal? No, I don't. Right? I don't like the ones with a decimal. It's too much thinking over there. So I'd pick the 155 strike, nice and easy. And it has a delta of 65, even better. So remember we said delta 50 to 70 is good enough for us. The strike being greater than the price of the underlying, again, it meets the criteria for a put. So I'd be picking the 155 strike. I'd be paying $6. right? Remember, whether it's a call or whether it is a put, does not matter. You're always picking the ask until that time. Until that time that we come to strategies that call for bid, right? Meaning that we're going to be selling at that time. Okay. Questions on that? Questions on that? You guys are good? Yeah. So that was a primer on how to pick strikes. We saw that it is better to pick strikes at the money or slightly in the money. They give you the best benefit. They give you, there's no guarantee, by the way, right? There's no guarantee. They just give you a higher probability of success, and they also balance your risk, meaning that as the price of the underlying either, confirms your theory, you're making a little bit of money. And if it is not going in your way, you're not losing as much money. You're not overbearing on one side. Cool. Any questions on that? No questions. You guys are good.
I have a question. It doesn't have to do with that. When you first start trading options, what's a good minimum balance that you should have in your account? What would you suggest?
Well, I would say that let's walk it backwards, right? What are your needs? Let's put it that way. You need some money, right? Walter's saying money. Money is the need. So how much money do you need? What are your goals? And they don't have to be the final goals. They can be your starting goals.
Starting goals.
Yeah.
Got it.
So what define that? Because this is subjective.
About $1,500 a week.
About $1,500 a week. Okay. So you're trying to figure out, how do you make $1,500 every week? Is that the goal?
Mm-hmm.
Okay. And now working backwards on that, you're trying to make $1,500 a week. You need some trades. How many times can you trade in a week?
3 with the trading rule.
With the rule, you can trade 3. Means that every trade you have to make at least $500.
Mm-hmm.
So we need to know how to make $500 every single time. Do you know how to do that?
No.
Okay. You need to come to my class.
I will.
Yeah, you need to come to my class so that I can teach you how to make $500 every single time.
But I mean, starting, how much should I have in my account? Like a minimum amount to start to even do that?
Oh, you can have any amount, because I have trades. I show people how to make $500 using $500.
Oh. Okay.
Yeah. So there are so many strategies that you can take advantage of that will give you $500. And that's the new minimum. When we talk about an A+ trade, the new A+ trade for 2023 is $500. It's no longer $300. Last year it was $300, right? Now we've bumped up. Cost of living has gone up. Right, Leslie?
So technically what you're saying is I could make more than my 500 in a trade.
100%,
Okay.
yes, 100%. I don't even have to say it. I think some of my students here can attest to trades that make more than 100% return on investment every single time.
But you wouldn't suggest that we use the entire amount in our account to do that?
No,
Okay.
not necessarily. So to go back to your question, I want to say that if you have about $3,000 to $5,000 in your account, then you are in a very, very good position to make that kind of money that you're referring to. You have to be very conservative. You have to be very diligent. You're going to be doing less trading and more waiting. That last statement was the most important. Less trading, more waiting. Every time you open your computer, you open Thinkorswim, there are 1,000 trades that you could possibly make to make $100, $200. Is that right?
Mm-hmm.
We are not interested in those. Anybody can make $100 easy. Just go buy one contract of Apple, wait for it to move $2, you've made your $100, right? If I buy this contract, this 150 contract, right? And Apple moves up by $2, guess how much I made? What's 0.57 times 2?
Is $1.14.
Yeah, so in real money, that's $114, right?
114, yeah.
Yeah, so that's all I have to do. Just buy one contract, wait for Apple to move $2, and I made my $114 and sell it. Those are not the kind of trades we want to do. Anybody can do that. We want to be very, very intentional in our trading because we don't have the luxury of trading that many times. We want to trade just about 3 to 4 times a week. Every single trade has to make us about $500. That's how you make $1,500 every single week, right? So I will show you in my class how we do that, how we plan for those kind of trades, how you understand what is that kind of trade that will give you that much money, right? How much risk do you have to put in? And that will answer the question of how much money do you need inside your account. So if you have the $3,000 to $5,000 in your account, that's great. If you have $100,000 in your account, not so smart. Not so smart. Because then if you have 100,000 in your account and you're only shooting for $1,000 a week, you're not managing your money well. And if you don't know how to trade, then don't put your $100,000 in savings into your brokerage account. Don't do it. Don't even move the PDT money into your account. Bad idea, right? The market knows you. They can smell you 1,000 miles away, right? They can tell you how they can tell when you're coming. They know when you open the account. So what I'm saying, let me finish that thought, is that before you move any sort of money in from your savings to your brokerage account and say that now I want to do this as my main hustle, you need to learn how to make that $3,000 to $5,000 grow into $30,000, right? And this is not done overnight. If you're looking for an overnight success, not going to find it, right? The best traders that I know, the best traders over time and the surveys that they have done, the best traders get their thesis correct 7 times out of 10. Imagine that. They're not making 100% all the time. 70% of the time is when they're right, which means that the other 30%, guess what's happening? They're losing money. Is that right? This is not about making money. So let's understand that. This is not about making money. This is about risk management. It means that if you can manage that 30% of the time that you're going to be losing, then you're winning. It's about risk management because you can't afford to lose more than you make. So let's understand the fact that you're going to lose. It's not an if. It is not an if. Let's get that in our mind. It is not an if you're going to lose. You are going to lose. But when you lose, is it a manageable loss? Is it a calculated loss? And it is a loss that doesn't have to destabilize your account. And those are the key questions we have to ask. So in our risk management, in my class, that is huge. We can't take any trades that are going to destabilize your account. So if you have a $3,500 account and the trade that you're making is going to give you $500, you can't be risking 500. That's a 1-to-1. Right? If you lose that 500, now your account is down to 3K. So we always have to think in terms of what is the potential reward and what is the risk that we're willing to take. So the risk is always going to be less than the reward. It must be, it cannot be greater than the reward. Never ever risk anything more than what you can expect to get. So when you see that and you set your stop loss, you don't want to watch it go down and you were going to make $200 on this trade and now you're negative 300. Already your math is bad.
Yeah.
Now it's no longer a math problem. It's a behavior problem. Right? It's no longer a math problem. I think you know the math. Everybody knows the math.
So I like what you're saying, and I'm wondering then,
Mhm.
you teach how to do this without using margin,
Yeah,
is
when you
what
do
it sounds like to me,
that is correct. In
which
fact,
is
when you do,
what I want to learn. Okay.
you're 100% correct. In fact, if you're doing options, there is no margin involved. You cannot do margin and options. You can do margin and shares.
Got it.
You cannot do margin and options. The only time that margin comes into play when you're doing options is when you're doing spreads, right?
Mhm.
And even then, the amount of money inside your account has to withhold the potential risk. So the qualifications to do a spread is that first and foremost, it must be a margin account. It does not mean that you're going to do margin. It just means that the settlement of your spreads is going to be sufficient to carry the risk. So we talk about that in greater detail. Otherwise, you can just use a cash account. No margin. We're not going to borrow money. Right? Not going to borrow money. So even when these brokerage companies say that, you put in $2,000, we'll give you 2 times as much or 4 times as much, that is for shares. That's for shares. We don't do shares. We don't do shares. Shares will not get you as far as you want. So, and also when you become an options trader, then it's like going on to the next level, right? When your neighbor says, man, I'm doubling in the stock market, I'm buying shares of TikTok and Tilray and all that, you'd be laughing all the way home, right? Instead, you're talking about calculated risk, you're talking about time, you're talking about leverage, plenty of things. So once you start doing options, you actually never go back to shares. Very, 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 very rare that you go back to shares. Does that help you there? Who was that? Was that Leslie?
Yeah, it does. Thank you.
You're welcome. Let's see. Price went up. Patrice says price. What price?
You said that you were joking earlier, and then she repeated what you were saying.
Oh, okay.
Because you were saying we no longer make $300, we make 500.
Yes, exactly. Yeah,
We're listening, Eddie. We're listening.
Yeah, cost of living
and
also
taking
went up.
notes.
I see that. I'm just catching up over here with the notes. Yeah, Patrice is keeping me on my feet here, on my toes. Huh? Thank you.
And Eddie, so basically when you're buying a call, you're going to go less than the current price.
Affirmative.
When you're buying a put, you're going to go above the current price.
Yes, you're choosing a strike above the current price. Okay. Yes.
Yeah. Yes. I just wanted to clarify that.
Yep. So 2 things that you want to make sure there, Walt. You want to make sure that the strike, like you said, is above the current price when you're doing the puts. And number 2 is that the delta is at least 50.
Okay.
Right. The higher the delta, the better.
Okay.
When you're doing calls.
Does the expiration date make a difference in the price sometimes?
Big difference. Yes, big difference. Yes. So that's one thing that we did not talk about because we picked an arbitrary expiration date. When you are actually wanting to make a purchase on a call, so if your thesis here is that, the 150, by the way, this is a really bad trade. This is a really bad trade because it's only moving up like $5, right? $5. But we'll keep the example here. When we're choosing what expiration and what strike, the first thing that we choose is the expiration date, even before we choose the strike, yes? So when I go to the options chain, notice that there's these numbers in parentheses on all the options. Here, 6 refers to 6 DTE, meaning that there's 6 days to expiration. Is that a good one? Maybe not, all right? And 13, 20, 27, my recommendation is 45 to 90 days, 45 to 90 days. The higher the number of DTE, the more expensive it becomes. So let's take a look and see the 21 April, which is between 45 and 90 days. I know that because in parentheses here, it says 48. So if I go here to the 21 April and I choose the 150 strike, assuming that the price is going to go up, guess what? I'm going to be paying $6.75 in premium, which is equivalent to 675 cents. And you might wonder, why would I want to pay $200 more? The other one, by the way, was costing $470. Why do I want to pay $200 more for the same thesis that Apple is going to move up $5? Why do I want to do that? Well, it's because you don't know whether price is actually going to go up in that amount of time. So when you buy a higher DTE, you're also buying time. You're also getting some other benefits as well. And that's the benefit of time decay, because the premium price has got a one component called what? Extrinsic value. Extrinsic value must decay to zero. So the higher the extrinsic value, the more it's going to decay. When it's out of the money, everything, 100% of the value of that premium is extrinsic value. It is not intrinsic value. Let me just show you that. I'm going to customize these. I'm going to add two columns here. One of them is going to be called intrinsic value, or rather just intrinsic. And the other one's going to be called extrinsic. And this, by the way, I teach in my class. When I teach the options chain, I go into detail for all of these things. So look at everything that on the call side, and we're going to examine the extrinsic value. You can see that the extrinsic value is closer to 100% of the premium. This is the premium, $4.10. The extrinsic value is $4.05. The value of the intrinsic is what? Zero. It means that if this contract expired right now, it would be out of the money. You'd get zilch, nothing, zero. Okay. But notice that the intrinsic value for, or rather the intrinsic value for everything that is in the money is actually a positive number. It's a positive number for everything that is in the money. So that's another case for, by the way, buying something that is in the money already. You want to buy something with value. It's like going to the store and buying a jug of expired milk because it's on sale for $20. Not $20, $2. How much is milk these days? Actually, let's go with eggs. No, do eggs expire? I don't know. Maybe they don't. But eggs are expensive these days, by the way. Anyway, you're buying milk and it's expired. Well, is it worth anything? Nah. It's going to make you sick. It's going to make you sick. So you don't want to buy anything that has no value. Eggs are almost the price of the house. Yeah, that's true. Yeah, when you go to buy a house, you gotta ask, does it come with the eggs? She's cracking me up, man. I even forgot the question. Yeah, there we go. So yeah, don't buy stuff out of the money. That's throwing money through the wind. So extrinsic value. Yes, Dora, you just put some eggs in there, you're guaranteed that house is gonna sell quick. Yeah. Yeah, add eggs. What other questions do we have on this fundamentals topic? Any other questions? Now I remember the question. Walt's question was, does the expiration date matter? The answer is yes. You want to pick a date that is 45 to 90 days. And the reason is that is going to give you flexibility in terms of time for your thesis to work correctly. And by the way, even if we buy 45 days, it doesn't mean that we're going to be in that trade for 45 days. That's a mistake that some people think, I don't want to be in this trade for 48 days. No, you don't have to be. You might be in this trade for 2 days, 3 days, 1 day. You never know, right? How do I know that? The ATR on Apple is about 3, means it moves about 3 plus or minus on any given day, at least for the last 14 days that's what it has done. So that's not a static number. It changes every single time. So right? There we go. Does that answer your question there, Walt? Does it help?
Yes, yes, you helped out a lot.
Awesome.
Thank you.
You're welcome. You're welcome. Cool. I think that that concept, we've pretty much beaten it down well. So for those who have not traded maybe 10, I started off by asking, has anybody here traded less than 10 trades? And I think just Walt said yes. Anybody else who has not had, who doesn't have much experience, do you have any questions on these? How can we get you started with options?
Eddie, I feel like I've traded more than 10, but clearly I've not traded them correctly. So,
and that's quite a possibility. You might be
yeah.
speaking for a lot of people there, because if you get the fundamentals wrong, Leslie, then you're simply throwing spaghetti at the
Throwing
wall.
money. Yeah.
Yeah, and just hoping that's going to stick, right? And that,
Yeah.
you might have been lucky. You might have been, I don't know,
I've
sometimes
had a
unlucky.
few lucky ones and
Yeah.
then other ones not so good. So
Mhm.
I want to be consistent with the in getting the 70, possibly 80% even
You bet.
with the wins. So
Leslie, you know
this
what
has
that reminds
definitely
me?
helped me a lot.
What reminds me of that, what you remind me of, Leslie, is, you know, you go to the bowling alley, you pick up that bowling ball, you just throw it. As long as you
Just
throw it
throw it.
straight, it's going to hit something, right? Unless they have the, especially if they have the guardrails. If they don't have the guardrails, then yeah, it might go to the gutter. But if it goes straight through, it's going to hit something. It's going to hit some of the pins, and some of them are going to fall. But what's the real objective? The real objective is that you hit all. Is it 9 pins? Are they 9? I don't go bowling that much. How many pins
10
are there?
pins.
There are 10 pins. All right, close enough. Close enough. 10 pins. We'll go with 10 pins then. So your objective is to hit that. Oh, no wonder it makes sense now. X. No wonder they write X. X in Roman is dumb, man. I should have gone to school. Yeah, 9 makes sense. It's starting to come together. So you hit the 10 pins. Your goal is to drop all of them, right? But if you don't have that sway, if you don't have that angle, that style, I see them, put one leg behind, stretching out there, they bend their body in a certain way. Those guys even focus. They're like, "Don't talk to me. I'm trying to bowl here." And those guys are focused, laser focused, and they come up over there. They're even, snapping their finger even before that ball hits the pins, because they know they hit it dead center. They got a strike. When you're doing options, you want to be laser focused like that. You want to be intentional. You don't want this unintentional profits, and you're like, man, I'm good. When you start winning like that and you don't even know what happened, your head becomes so big, your ears in different zip codes. So you don't want to be intentional. That's why I said, going back to what I said, less trades, but quality trades. We broke down your problem. Your problem was, I want to make $1,500 a week. That was the problem you presented. We saw that you can only trade 3 times a week, and each trade needs to make at least $500. That's your best case scenario. So how do we learn how to make $500? Right? We need to learn how to make 500. Actually, we need to learn how to make more than 500, because if that's the goal, we might not meet it. Remember, we live on the rule of what? 80-20? Have you heard of the 80-20 rule?
Yeah.
80-20. So if we're doing something good 80% of the time, that's pretty good, right? So what if we made $500 the 80? How about that? So how do we do that? 500 divided by 80%, right? It means we have to shoot for $625, give or take. See how I did that math? Yeah. So we need to shoot for a whole lot more, so that if we're doing 80-20, we're meeting that $500 about 3 times a week, or even, 2-3 times a week. I'd say even 2 times a week. Tell you what, even to start with, don't shoot for 1,500. Now, I know in motivational schools and motivational speeches, they tell you go for the sky, don't go for whatever. But I tell you what, go slow. This is one industry you want to go really slow. You want to be intentional. And I would rather you make just one $500 trade a week than lose $50 a week. right? I'll say that again. I'd rather you make just $500 a week than you make those 10 trades, and at the end of the week, you have lost $50 and you feel real good. I only lost $50, but you lost. Whereas if you just make one good trade of 500, you're going to be singing all the way to the bank, right? Your stress level is going to be this much, very, very low. This is a stressful job. It's a very stressful gig. So I want to teach you how to trade smart. I want to teach you how to make the best use of a little money and how to grow that. So if you have $50,000, you already know how to make 50K. Maybe you should stick with that. But if you want to know how to grow 3 to 5K into that 50K, then we need to talk. We need to talk, and we need to do this consistently. It's not going to take you overnight. This is a process. This, it's a mind change. There's also, because I know what school you're coming from, there's going to be a lot of unlearning. Right? There's going to be a lot of unlearning because you've been learning some really bad stuff or some really crazy stuff, stuff that doesn't work. We need stuff that works. I'm results based. I need to see results. The only way that I can see results and that I can point to is if the bottom line, the PL at the bottom, is black or green. That's your benchmark. If it's red or always red, we don't need it. We really don't need it, right? It means you're doing something wrong. If you're doing the same thing over and over again, that is a definition of what?
Insanity.
Love it, love it, love it. This is my model student. This is my model student. So,
who's your model student, Patrice?
Yeah,
or
no.
you
I'm calling you are my model student.
Oh, because I'm
yeah.
Told you the insanity.
It's inside. Yes, I mean you got it right out the back. I mean, no thinking twice. You didn't have to phone a friend. Was it last week? Was it last week you had to phone a dog? Was that you?
No, I wasn't with you last week.
A couple weeks ago, somebody had to call their dog.
Oh, that wasn't me.
Wasn't you? Okay. Well, somebody had their dog barking in the background. We said we're going to call a dog to help us answer the question. So, yeah. So this is good. What else what other questions do you have? I know it's about 12:30. I don't want to keep you guys so long, but what are the kind of questions you have?
Eddie, I wanted to know now, with everybody's busy work schedule, talking about mine as well, is there some kind of way where you get into an options trade and you can like set it and forget it to where once you reach your price level where you want to take profit, will it take profit for you? And you look at your phone or your laptop and see that you then made your $500 for that particular trade?
That's what we do. Yeah. So there are two types of traders. There are people who are able to actively trade a couple hours in the day, and they're able to focus on their trades. And then there's people who just have a job that they have to attend to. For instance, if you're in healthcare or something like that, working with people, you can't be telling them, hang on, let me check my Thinkorswim. So you need different strategies, and we have different strategies for different situations, especially those who are very, very busy. So we'll teach you, or I will teach you, how to put those trades on, where to look for them. They are slow moving, they are low risk, and they also provide a good return on investment. It also means that you don't have to look at your phone every 20 seconds. In fact, if you're looking at your phone every 2 minutes trying to see whether you've made money or losing money, then that's not very helpful. You don't want to make this into a second job. Now, so if you stick with me, I will show you how to plan your trades. Remember, we're going to be doing a whole lot of waiting. Our objective is 2 to 3 trades, quality trades, I should say, 2 to 3 quality trades every week that are going to make the difference. You're going to make a whole lot more than the guy who's trading like 10 times a week. That's your objective. Once you figure that out, scaling up is very, very easy. Scaling up is very, very easy. It means, in fact, if you just went with just one additional contract a week, you've just doubled your income. Right? The 1,500 that we are referring to is based on one contract per trade. Just doubling that puts you at 3,000. Yeah. So come to class. We'll teach you how to read a chart, how to draw support and resistance, how to plan the trade. Those are the very, very basics. That's going to take about 2 weeks to do that. Lots of practice. In the first 2 weeks, we don't trade live. We trade in the paper trading. We don't care how much you make in paper trading. We know you can make 1,000. You can make $1 million in like 23 minutes, maybe 24, right? We don't care how much you make in paper trading. What we care is, do you understand what happened? Do you know how to place that trade? Do you have the mechanics down pat? Because when you go over to live, that's not the place to be figuring, oh my goodness, this is how I take profit. I've had students before, many students, not just one. I've had students who are in live and they're like, I'm up $900. What button do I push to take this 900 home? And they're looking for me left, right, and center. They're asking in the forums and all that. Before you know it, that 900 is no longer 900. It is now 800. It's now 600. And when they finally figured it out, either they are picking up $100 or they're in the negative. Are you familiar with that story? Anybody? Yeah. And you guys are good. None of you have been in that situation. Clifford says he's done that. Familiar, yeah. I mean that happens. Or and that's probably the better situation. What about that situation where you enter into a trade live? Maybe you picked the wrong button and now you're going negative and you're screaming. You're like down 200. You're down 300. You don't know how to get out. And by the time you figure out how to get out, you're like, dude, just take it all. Yeah. You don't want to do that in live. You want to do that in paper trading. You want to learn how not to do that in paper trading, right? Figure it out and learn, experience, break it. In fact, in sim or in paper trading, we're going to make some bad trades just so that we can see how to fix that. That should be part of the exercise. So 2 weeks, no live. After 2 weeks, we're going to make one trading live, everything else in sim. By the end of the training session, more than likely, you'll have made your money back. More than likely. So, cool. All right.
Hey, Eddie.
Yes.
Hey, this is Byron.
Hey, Byron. How you doing, man?
I'm doing well.
Awesome,
Glad you're feeling better.
Yeah, I am. I'm trying. Well, you can hear my voice is a little, it's going out again now, but talk to me.
Yeah, hey, I just like to say for the group that's on the call, those that I've been rolling with Eddie for something over a year now, I guess. And his class is I took his class. It's a good investment if you guys are considering it. I do work a 9 to 5, kind of like Walt was saying. I don't trade every day, kind of because of that 9 to 5. But when I do trade, I can routinely do $1,000 easy, $1,000 plus, based off of the strategies that Eddie shared over the last year. And he said one time, I know Eddie mentioned that there's probably 1,000 different strategies out there that you can make money with. Even on the option side, he doesn't teach that many. I think what Eddie does teach is kind of conservative, and I can vouch that it does work. I have made I have made $5,000 in like 10 minutes. It was an accident. And what happened is I was after 5 points, and normally I trade on my iPad, and this particular day I switched to my desktop. Well, my desktop, was set up to, by default, to buy 10 contracts. So when I purchased, I didn't pay any attention that I was buying 10. I didn't mean to buy 10. That wasn't my goal, was to buy 10. I really was only gonna buy 3. But I bought 10, and it happened so quickly. It run up so quickly. I had $5,000 before I could get it is, my take profit had hit,
Yeah.
and it took me out.
Awesome.
So, yeah, but so that's kind of a good story. And then on the risk management side, that's a big deal. If you can, I think what he says about what my experience has been, what he says about the consistency is true. You can make $5,000, or you can make $1,000, or you can make $500. But whatever you do, if you're consistent about it, it adds up. If you make it and then lose it, the net's zero, and that's not what anyone's out there.
Yeah.
So again, I just encourage you guys, if you can, it'd be a good investment. And it's a PSA, and he didn't pay me. I'm not on this payroll to say that. Okay, he's a good guy.
I appreciate that, Byron. Definitely. Yeah, I did not pay him. Byron's one of my students. Very successful, and that's a great success story. And maybe even going back to Leslie's question of how much money do you need, or how much can you make? The 1,500 is actually conservative. You can make that very easily. On Thursdays alone, when we do a Thursday morning, I have found that a lot of people are actually making even $1,000 on that particular day. And that's just one day a week when we all trade together live. On those days, collectively, I think that one of the day when I started tracking how much people are making, I think on one day we traded for about 1 hour and made $15,000. That's the students. That's not including my trading, right? And that's because we trade live. You watch what I'm doing, you hear my thoughts, you see what I'm doing. I don't tell you what to trade, by the way. I'm not a financial advisor. I will not tell you what to trade. That's one of the things I don't do. I want to make sure that you know what you're trading and teach you how to build those trades. Because when it's your trade, then you have the confidence, you know exactly what the outcome is supposed to be, and you also know how to defend that trade. So kudos to you, Byron, and thanks for that PSA. That was awesome, man. That was awesome. Thank you. So, and even as you listen to all these PSAs, understand that success. This is the small disclaimer part, by the way, that it's not everybody. Right? It doesn't mean that we can all be good, and I don't claim that I will teach you to perfection to where, this is the magic pill. You take Eddie's class and, retire early. No, there's a lot of work, and you're going to do the work, not me. I'm just here to help you out. And I'm proud to say, I think I can do a good job. I think I can help. I've helped a lot of students. So yeah, takes a lot of patience. You have to watch those videos. You have to practice. You have to ask those questions. You have to be engaged. You have to just be involved. You can't just sit back and expect that it's going to come to you. Some of these things don't make sense until you actually try them. I can always tell the people who did their homework and those who did not, because I give homework, right? And the questions that you're asking, or that the students ask, tell me where you are. Tells me what you understood, what you paid attention to, because I've taught hundreds of students, and I know, based on what they're asking, what is the part that is bothering them. So cool. Appreciate that again, Byron. So let's see.
I have a question.
Yeah.
I recently read an article about how the number of people trading zero DTE has gone from like 14% to 40-something%, and that's been messing with the markets. What are your thoughts on that?
I don't know what to think about that, because I trade zero DTE a lot, but I found that I don't think it's a question of how many people are trading it that affects the trading, but it's the movement, it's the way the market is. I think the market, the reason that people are going to, well, I'm going to theorize here. I didn't think about this prior to this hearing your question, but I think the reason that people go closer to zero DTE is because of the price of the premiums, right? And when people say zero DTE, they're mostly referring to S&P 500. That's the one that they're mostly referring to. So S&P 500 being one of the most highly traded securities is a very, very expensive, security. So you can see, for instance, the one trading on Monday, obviously these prices are going to come down. These are more than, but these are Friday's prices. But you can see they're already in the $1,400, all the way up to $2,000 per contract. But if you were to go even just 9 days away, you see that we've tripled the price, more than tripled the price. Now at the money is about $4,400 or $4,000 if you're buying puts. So one of the reasons I think people go closer to the money, closer to zero DTE, is because of the price of the premiums. If you were to go 45 to 90 days on SPX, you might not afford it. So April 21 is 48 days DTE. At the money, one contract is $113.90. Let's call it 114. That would translate to $11,400 per contract. So we can already see that if your thesis was going to be based on that, unless your name is Bank of America, Chase Bank, JP Morgan, then you're probably not going to be buying that, right? So that's why maybe a lot of people go closer to zero DTE. I don't know that it affects a whole lot. There's probably more to that story, Dora. I'm not sure what else there is to that story, but do I recommend going zero DTE? Only for very specific strategies. The strategies that I teach will more than likely be having you go 45 to 90 days, and I have strategies that will not cost you a lot of money. I'm considering that everybody in the class is usually starting from between $3,000 and $5,000, and so we have to think in terms of affordability and being able to do about 2 to 3 trades every week, and be able to make that. So there's probably more to that story, Dora.
Okay.
Yeah. A whole lot more. When you're starting out as a beginner trader, you don't want to be doing zero DTE. That's a lot of risk. So let's talk about that for a second here. Zero DTE means that you've got 6.5 hours to make that trade work. Sometimes less. Is that right? Because market opens at 9:30, closes at 4 o'clock. That's a very short time. Your trade has to give you what you want it to give you before 4 o'clock that day. Otherwise, you're going to be out of the money and you're going to be at a loss. So if you're not very experienced, or even when you're experienced, if you're on the wrong side of the trade, that's a very risky position. In my class, actually, I've showed people that when I do zero DTE trades, I usually do them in the first couple hours of the day. If I'm going to be trading anytime after 11 o'clock, it's not zero DTE. I need more time than that. I'll more than likely be doing 2 or 3 DTE. Why? Because I want to get some assurance. I want to manage that risk a little bit. And knowing that I only have 4 hours left in the day, that's not a very good feeling. I ran out of heart medication the other day. Right? I don't want to be in the business of heart medication or stress medication. No, just give yourself a bit more time. Go 2-3 days. But quite seriously, if you want a good trade, you will wait. And you will find a strategy that doesn't involve you adding that much risk to your plan. So we've talked about plans as well. Your trading plan, it's got to be one that gives you that peace of mind. When you put in that trade, we need to be comfortable enough that we can go shopping, we can go to work, we can go wherever we want and not worry about your trade, right? If you're doing 0 DTE, you're not leaving that computer all the way until you close your position. So don't do 0 DTE. Good point there, Dora. All right. Turn off stop sharing here and see if there's let's see what's in the chat. Van wants to know, if I have a margin account, can I use that account to do options too or not? Or you can do options in any account, Van. So if you have a cash account or margin account, remember, margin or cash, that's just the type of account. The other thing that you have to consider is, are you approved for options? So you need to be approved for options. The simplest level that to be approved of is, I think, just buying puts and calls. That's the beginning level. Next level up would be to be able to do spreads, and that's the one that you want. So if you have not asked your broker for permissions to do options yet, make sure that when you ask, make sure they include spreads.
Okay, yeah. Thank you so much.
Cool. Mm-hmm. So, and then also understand the difference between a cash account and a margin account. Are you familiar with those differences there, Van?
Yeah, right. So yeah, I'm just like a beginner. So I'm really like still working on like which accounts I'm really just gonna need to open. I was just thinking that like in the margin account, it will allow me to, so because I haven't started, I didn't realize that this was about options. So I'm just starting to get into the options. I just finished the basic in trading.
Yeah.
And so, yeah, if you could explain, I would appreciate it. Thank you.
Yeah. So when you're getting into options, you can get either a margin account or a cash account or both. Let me explain the differences. If you just want to do calls and puts, then it doesn't really matter which one. But let's keep talking, and then you're going to figure out which one you really need. And let's talk about the differences. With a cash account, let's say you have a cash account worth $2,000. Okay, $2,000 is how much you use to open your cash account. This is just an example.
Right.
If you make a trade on S&P 500 and you use $1,500 on that account and you make, say, $500, now your account value is how much?
Sorry, I was not.
Okay, so you have a $2,000 account, Van, and you have a cash account. You make a trade, you spend $1,500, you've got the wind beneath your wings there, and you make $500. So now your account value is what?
So I traded 1,500. Is that what you said?
Yep, and you made 500. Yeah.
So my total is
the balance on your account is now how much? 2,500. That's correct. Yeah. Can you make another trade that day for, say, 2,000? You don't know. The answer is no.
Yeah.
The answer is no, because you've already spent $1,500 of the initial 2,000, and it has not settled yet. It takes 1 day to settle that amount back into your account, including however much you make. So in this particular example, even if you made that $500 and now your net, it's called net liquidating value. The net liquidating value of your account is now 2,500 once it settles. The question is when does it settle? And if you were trading S&P, it's going to settle the next day.
Oh, okay.
Okay, which means that money that you spend, the 1,500, is not available for you to spend. Instead, what's available for you to spend is the $500 left out of the 2,000 that was originally in the account, not the one that you made, but the one that you did not spend. So you can buy another contract for 500, but that's all. If you had a margin account, it settles immediately. So now your net liquidating value is 2,500, but you can now buy a contract worth 2,100. See that? 2,100. So that's the difference. That's a major difference between a cash account and a margin account. The margin allows you to use that money that has not yet officially cleared completely,
Right.
And use it for your benefit. Whereas the cash account, everything has to clear. Now that example was on SPX, S&P 500. It's an index. It's cash settled, right? All indexes are cash settled. If the trade was on another security, for example, Apple, Amazon, Google, Meta, whatever, it would take 2 business days. It means that that amount of money would not be available for you and for 2 days.
For a cash account.
For a cash account. But for margin, it would be available same day.
Oh, okay. Yeah.
Does that make a difference?
Yeah, it does. But
okay.
The thought of just the margin account scares me because,
Well, when we say margin account, you're thinking in terms of borrowing money from the broker to buy shares or buy something. Right. When you're using options, when you're buying options, you're not going to be borrowing any money. The broker is not going to leverage that much money for you. They will not lend you money to go buy options.
Yeah, that's what I learned from you today. Thanks.
Yeah, that is not going to happen. In fact, the only way that you can use money that is not yours is by selling options, selling something that you do not own. It's called selling naked. Meaning that you do not own any of the underlying security, you're just selling it, you're borrowing it from the broker, and you require margin to do that. You need margin in that scenario. But that's a strategy that we do not teach, we do not recommend. In fact, the only time that we sell, because I will teach you how to sell, is when you're also buying, meaning that your sale is not going to be naked, it's going to be covered. So when I say naked here, I'm not referring to not having clothes on. I'm referring to not owning the underlying, right? So margin accounts, you need a margin account when you need to be able to sell and buy at the same time, right? Unless you have a grandfathered account. For example, I have a grandfathered account that, because my TOS account is more than 15 years old, but back then you could do spreads on cash account. So I can still do a spread on a cash account, but I've discovered that these days you cannot do that.
Yeah.
Right. So with new accounts on a cash account, you cannot do spreads. You cannot get that privilege. It has to be a margin account.
Yeah. So my question is, like as a beginner, like I've no experience.
Yeah.
What would you recommend for me to open starting out?
What would I recommend? I think, so this is similar to Leslie's question. She was asking how much do you open an account with? Your question goes a little further with, do you need a cash or a margin account? I would say go with a margin account, right? Go with a margin account. Here's why. With a margin account, you will be able to do spreads, right? You're going to be able to do spreads, but with a cash account, you won't be able to do spreads. Also, notice that one of the downsides of a cash account, of a margin account, is that you immediately have something called the PDT rule. Have you ever heard of PDT?
No.
PDT is pattern day trader.
Right.
What that means is that FINRA, or the body of government that regulates this particular industry, says that if you have less than $25,000, if you have less than $25,000 inside of a brokerage account that has the margin feature enabled, keyword 25,000, keyword margin. If those two conditions are met, you cannot trade, or you cannot open and close more than 3 positions, more than 3 trades in a 5-day rolling period. That's a lot of words, isn't it? It's a lot of words. It simply means you're going to trade 3 times a week.
That's if it's less than 25.
Yes.
Like any amount. Less
Yeah.
than 25.
Less than 25 on a margin account 3 times a week. Why 3 times? Because in a week there's about 5 business days, and assuming that your week starts on Monday, then you can do all your 3 trades on Monday, and then you won't be able to trade Tuesday, Wednesday, Thursday, Friday. But you're
Right.
only allowed 3 opening and closing trades in a 5 business day, not weekends. Don't count weekends and holidays and weekends. Yeah, don't count those. It has to be trading days. So that's one major disadvantage of margin account. But if you're trading smart, the way we teach to trade, that will never be a problem.
Right. Yeah.
On the other hand, if you have a cash account, you can trade every day. You can trade 3-4 times a day. But you have to wait for whatever you traded to clear. Do you see what the drawback is?
Yeah. It takes a few days.
Takes a few days, or it takes a day or two to clear. So you have to balance what is your objective, what is your strategy. And if you want to take advantage of some of our better strategies, then a margin account is what you need.
Right. Yeah. Thank you so much, Eddie.
Cool.
Yeah, that's very valuable to me.
No problem. No problem. You're welcome.
Eddie, now, what would you say about LEAP contracts as we're doing, option contracts for right now? Now, for the long term, would you recommend LEAP contracts as well, to where we can have maybe more than one pot, going on, something for the short term and something for the long term?
Absolutely. Yes. I do teach LEAPs. So we talk about LEAPs in my program and when is the best time to do that. LEAPs, for those that do not know, LEAPs, that's an acronym for long-term equity anticipation securities. What that basically means is that you have an options contract. Usually it's going to be a call. Almost never is it going to be a put. So it's almost always a call contract that is at least 9 months DTE. The LEAPs that I recommend are usually going to be about 2 years, 18 months to 2 years, or even 3 years. Those are the best LEAPs. And there's a particular strategy that we go for. So to answer your question there in more detail, Walt, I would have a separate account for LEAPs, right? And why would I do that? Maybe I don't want to see it in my face every day and look at it. Well, the good thing is if you're using Thinkorswim, you can have several accounts with just one login, and you can segregate the types of strategies based on the objective. So yes, I would do LEAPs. That's where we talk about long-term. Here's what to do with the money that you have made. Now that you know how to manage $3,000 and you've made $5K, and you've realized that you only need about $5K to make your $1,000 every other day, what do you do with the rest $5,000 in your account? And this is when we start talking about long-term securities, something that is going to quote unquote hedge your position or hedge your portfolio, right? This is how you grow your money. You don't pull the other 100,000 you have in your bank. No, you don't do that. You never do that. Go buy some real estate instead, right? Seriously, don't put 100,000 in the market. No, don't do it. Yeah. Go get something that does not decay, that has less risk than the stock market. The stock market has got a lot of risk. So does that help there, Walt?
Yes, that's very helpful. I think right now, it seems like a LEAP contract type of time, because you say you're going to go buy calls for the LEAPs or whatnot.
Yep.
And the market is going down right now. So,
Yeah.
Eventually it's going to go back up, and so for the long term, LEAPs would probably be a good investment.
Absolutely. Yeah. Yeah, absolutely. So historically, at least for the last couple 100 years, the market has gone up. It's gone up. And we know that LEAPs do in fact work, except for the last 2 years, they have not worked. Right, last 2 years, we also, what happened in 2021, we were confused. In 2022, the market told us for sure, you guys are not going to make any money. In fact, the statistics are that most accounts lost approximately 23%. That's across the board. 23%. Most 401ks lost about 23%. That's a huge amount of money to lose. But that is unrealized. The only time you lost it, if you crystallized, if you sold, then you crystallize that 23% loss. What the market has also told us, or what history has also told us, is that following such a decline, the market usually comes back and doubles what it lost. So over the next few years, by 2025, 26, we should see an uptick, maybe even 46%. That's just the statistics. How many times has that happened? All the time, right? Do we know that it's going to happen this time? I don't know. No idea. I couldn't even spell COVID when it first came out, right? None of us could. So this is not, even if we have statistics, that just helps us understand what the probability is for the future. It's not 100% guaranteed. Let me read this question. I'm in Canada and I'm a true beginner. I just read that PDT rule does not apply to Canadians. Do you know if that's applicable to margin accounts? So the answer to your question, however, that is correct. If you're in Canada, you are not affected. You are not affected by PDT. That is only something that affects people in the USA, right? It does not affect people in Africa, in Europe, Asia, Canada, Mexico. That is only a USA thing. So if you have an account based in the US, then you are subject to the PDT rule. If you're in Canada, you can trade 27 times a day. Does that answer your question there? Doesn't matter whether it's a margin or cash. There's no PDT in Canada yet. Mr. Trudeau does not know that. Don't go telling him about it. I'm really looking forward to conversation questions that we'll have. Oh, yes, Leslie. Yeah, thank you. I'm looking forward to the journey with you. Okay, and Byron is restating that if you put time and work, yes, there's money to be made. Awesome. Well, guys, it is Saturday. It is about 1 o'clock. Do we have any last minute questions? Any burning questions? Anybody? Let's see. You all know how to get to my websites, yeah? You all know how to get there?
Yes. Eddie, I want to know if you could repost this a little sooner than normal, because this has been such an awesome session to where I want to, listen to it over and over again, at least 2 or 3 more times.
Yeah.
I mean, all of your sessions are great. And this one here, I mean, I just want to listen to it. I know you have to edit, whatnot, do your thing with it, but can you get it up tomorrow, please?
In other words, don't go to sleep.
Do we find the recordings up in the Facebook?
I have a YouTube channel. So the best way is to subscribe to the YouTube channel.
Oh, I'm subscribed. Okay.
Yeah, and then hit the bell down here. I want to feel like a YouTuber. This cracks me up, man. I don't know how this guy knows. Is it this side or this side? Something like that. Anyway, but yeah, hit the bell, hit subscribe if you like it. Obviously, if you have any comments, by all means, keep them civil. Just ask. I'm happy to answer. Yes, I will post this as soon as possible.
Thank you. Yeah, the bell is to your left, Eddie.
Is it to my left? All right, this way.
Yes.
How about that? Push that bell down here. Actually, I've had a guy say, smash that bell. Go ahead, subscribe, smash that bell. Give it a thumbs up. What's your name on YouTube? My name is my name. Let me push the
options with Eddie.
Yeah, on YouTube it is. There we go. Thank you so much, Dora. There we go. She beat me to it.
Walt, I put a link in chat for you on Saturday session with Eddie that I think he talked about leaps in that.
Thank you so much. Thank you.
You're welcome.
Cool. Thanks, Dora. There we go. All right. So yeah, my name, pretty simple, Eddie Gichuhi, and I'm also considering synchronizing that with the brand options with Eddie. So you might see that change in the next few months, but everything's going to carry over. It's just going to be easier to spell, easier to find. At least that's what my marketing guy is telling me. So cool. All right, guys. Well, I am out. Today's Saturday. I am going to enjoy the good weather. I'm going to see if I can get some honey, cool my throat a little bit, get ready for Monday. All right, guys.
Hey, Eddie,
I'm out. Yep.
nurse speaking here.
Yep.
Get you some NAC, zinc, and
Let me take some notes. Get some what?
NAC, it's N-acetylcysteine. And if you say NAC, they'll know what it is.
Yeah.
Zinc and vitamin D.
Oh,
Good for respiratory issues, and it'll knock everything right out, build your immune system.
yeah. So Jack Daniel's not a good idea, huh?
If you add honey and lemon with it, that'll help too. Make a nice hot toddy. Get some echinacea tea.
There we go. There we go. I'm following your advice, not mine. So lovely. Thank you so much. All right, guys. Well, thanks for being with me on
Welcome.
Saturday. We will see you soon. And I'm going to post when the next class is going to be on the website. So I haven't got the websites. I mean, the dates just yet, but I'm going to post that pretty soon. So Hava says honey, ram, and lime. Yeah.
Yep.
Nice.
That's March the 18th, right?
March the 18th. What's happening March the 18th?
It's 2 weeks from now.
That's for the Saturdays with Eddie, yes.
Okay.
But for the upcoming class, if you're interested in that, I'm going to post it on the website, and I'm also going to post on Facebook as well.
Okay.
All
Thank
right,
you
so-
very much.
All right, thank you.
Thanks, Eddie.
Have a good afternoon, good weekend, everyone.
You too,
Bye.
Eddie.
Yeah.
Thank you.